Hello, and thank you for joining us for this Southern California housing and economic update for the week of July 30th. My name is Jordan Levine. I'm the Deputy Chief Economist here at the California Association of Realtors, and I'm here to bring you the good, the bad, and the ugly of California, and more specifically, Southern California's recovery. On the good front, we have seen significant progress made both in terms of the economy overall, as well as the housing market in particular. One of the most encouraging signs is just how much demand there is out there from home buyers. And in some ways, that highlights just how much the current crisis has really improved the value proposition of the home. And indeed, we see in our weekly survey of realtors that they're feeling more optimistic about the future. On the bad side, we do see that our age-old problem of a lack of inventory starting to rear its ugly head again, and in fact starting to impede the recent recovery that we have been enjoying. And although realtors have reported feeling more optimistic in our weekly survey, when you drill down and ask about their business and how it played out last week, we have seen weaker numbers in recent weeks. And in fact, we saw closed sales dip in our weekly MLS data as well. Looking forward, the more ominous signs are that a few of our key economic indicators have started to move in the wrong direction over the course of the last couple of weeks as the level of uncertainty and downside risk for the economy has grown in recent weeks. And indeed, we see that starting to play itself out in our forward-looking market indicators here in California for housing as well. But let's talk about the good news, right? Because when you look in the rearview mirror, we have had a couple of months of pretty significant progress. Indeed, if you look at the labor markets in California, we had one of our biggest increases in non-farm employment ever recorded, more than 500,000 jobs added back during a single month. And although we've still got significant progress to go, that's 2 months in a row with multiple 100,000 job months. Similarly, in terms of retail sales, which are critically important because consumers in the US economy still represent almost 70% of GDP. So in many ways, as go consumers, so goes the economy overall. And if you, particularly when you strip away auto sales, and we know that car sales haven't come all the way back yet, but if you look at just retail sales minus those food and auto sales, you can see that we're back to pre-crisis levels in terms of consumer spending, which again is critically important for the economy as a whole. A little bit closer to home, or in our own backyard, if you will, we've seen rates that have fallen to all-time low levels. In fact, last week we had a 30-year fixed rate mortgage that averaged less than 3%, and that was the first time in recorded history we have seen that. And this is why that matters so much. What I'm showing you here is the monthly payment, just the principal and interest, on the median priced home, both today or as of our June press release, which cost $2,160, and just how that compares to what the monthly payment was on the median priced home back in 2018 when we averaged almost 5% interest rates. There's currently $300 in monthly savings from the median priced home that you would have spent a few years ago. And that's despite the fact that June was a new all-time high in terms of the nominal level of prices in the economy. So more expensive home actually costing you less on a monthly basis. And that $300 savings that I'm showing you here for this kind of stereotypical median home accumulates to over $100,000 a year in saved interest payments over the life of that loan. And so this is a real financial opportunity for those who maintain their income and are feeling confident in their job to take advantage of these historically low rates. And indeed, we can see in the mortgage applications data that although we had a weekly decline last week by about 1.4% from the previous week, when you look on the right-hand side, you can see that compared to 2019's pace, we actually had an acceleration that normally applications dipped by even more than that during that final week of July. And again, we're still running more than 20% ahead of 2019 levels, despite elevated levels of unemployment, folks who still aren't working, et cetera. So it just goes to, again, underscore how much the value of the home has really improved and how that's really being magnified by these historically low interest rates, making a lot of people want to jump into the market. And indeed, when you look at the Southern California housing snapshot for June, you can see that we recovered much of the lost ground. Not all the lost ground, but a significant chunk of the lost ground from when home sales declined in April and May. In fact, in June, we are back to just quote unquote 12.2% behind 2019's levels after running more than 40% behind last year's pace just a month ago. We saw home prices are back on the rise, hitting $589,000 in Southern California last month. But more importantly, we've seen inventory dip back down below 3 months of supply as home sales have started to come back. And so therefore, we've seen homes still selling quickly. The median days from listing to pending last month was just 20 days in Southern California, and homes were selling effectively with no discount, with a median sales to list price of 100%. And indeed, when we talk to realtors, in our weekly survey, which we just finished on Monday, the 27th, realtors were more optimistic about listings going up, sales going up, and prices rising this week or in the weeks ahead than they were even just a week ago. And so overall, the economy has improved. That has played itself out across the market statistics that I shared with you. And we do see realtors reporting increased levels of optimism. Now, the problem is that the lack of supply, which was a huge issue before the crisis, is starting to rear its ugly head again, and indeed hold us back from turning so many of those would-be buyers into actual home owners. If you look at it on a statewide level, there was 43.6% fewer active listings last month than there was at the same time in 2019. And so even with all these mortgage applications, requests for private showings, all these other measures of housing demand, there just isn't the listings to put these buyers into, and that is starting to take a toll. Indeed, when you zoom in to Southern California, you can see that after enjoying a fairly healthy recovery in pending sales back in April and the beginning of May, we essentially haven't had much growth in new listings coming onto the market for the last 2 months. And again, we have lots of buyer demand out there, but in Southern California, we just cannot find the inventory to put these people into. And that is why you see pending sales, which enjoyed a nice run again from mid-April right up through the end of May, have basically for the last month and a half, almost 2 months now, been essentially flat, and pending sales in Southern California actually fell last week for, I think, the third time in the last month and a half. And so thus, it is not surprising that we've seen the pace of closed sales slow as well in Southern California. And indeed, I think we had our first decline in closed sales going all the way back to late May or early June. And so, this isn't because of a lack of demand. We see lots of evidence that buyers want to buy, but I do think that our lack of inventory is really starting to hold the pace of the recovery back. And indeed, we see that realtors are reporting that they did fewer listing appointments last week than they did the week before. We had a modest increase in the percentage that have entered escrow last week, but what you can see is that over the last 3 weeks, the percentage of realtors that we're talking to entering escrow that week has been down from where it was about a month ago. We had fewer realtors, just 21% close a deal last week, and that's the lowest level that has been in a month. And so I think that, again, the lack of inventory, which wasn't that big of an issue when sales took a big step back in April and May, is becoming a problem again as buyers have really tried to re-enter the market at such favorable rates. On top of that, we have some structural issues that are going to remain ongoing headwinds, with both the number of COVID cases and COVID deaths in California rising. And that means likely that there's going to be ongoing restrictions that prevent us from getting on a full recovery footing, at least in terms of the general macro sense. We just got the GDP numbers for the second quarter this morning as I record this, and we know that we had our single largest decline in recorded history, with the economy contracting by 33% roughly in a single quarter. And so even with this recent progress that we've enjoyed, without this recent uptick in uncertainty and things like that, we still had a big hole to climb out of. It's not to diminish the progress that we've made, but just to say that we have a long road ahead of us. And you can see that when it comes to the labor markets, that nationwide we have added back over 7.5 million of the jobs that we lost, and yet we still remain about 15 million jobs below those pre-crisis levels. And so again, we're moving in the right direction. We have moved in the right direction, but still a lot of healing left to be done. And in fact, we've actually seen, with the uncertainty and the uptick in COVID and the decline in business activity associated with more or new shelter-in-place rules, that the number of folks filing for unemployment has now increased 2 weeks in a row after declining for 14 consecutive weeks. We're not back to those kind of early crisis levels, but things have started to move in the opposite direction that we'd like to see. And of course, in California, we're on the leading edge of that trend, with new jobless claims, folks losing their jobs for the first time, increasing in 6 out of the last 10 weeks. A lot of progress from where we were back in late March, but again, still seeing an increase in the number of folks losing their jobs again, and that will have kind of macroeconomic ripple effects that will eventually impact housing. And this is one of the areas that we see that, right? After 2 months of retrenchment or rebounding, we saw that in July, consumer sentiment actually fell back down as job losses increased and folks were forced to stay at home again. And again, this is critical because consumers are still 70% of the economy. And so as consumers take another step back, we can expect the recovery to slow as a result of that. And perhaps the bigger concern is not just that we have fewer homes going into escrow each week, but actually that we've seen the percentage our realtors are telling us increase in the number of homes that are actually falling out of escrow. And they haven't risen to crisis levels, but they have consistently moved up from where they were in late May, early June, at about 5% of realtors that we talked to, up to 7% over the weekend. And so that is something to keep an eye on, as well as economic difficulties and job losses start to ramp back up. So in summary, I would say that we are definitely have seen a lot of progress. We were on that road to recovery, but I would also caution you against celebrating the June numbers too much, because the forward-looking indicators show that road to recovery, particularly in Southern California, is going to be windy. It's going to be fraught with bumps, and that we've got a long road ahead of us regardless. And so we will continue to keep you updated as things progress, and we'll be back with you in a few weeks. And until then, I will say thank you so much for joining us on this Southern California economic and housing market update, and we'll see you on the next one.